Hi everyone and welcome to a new video. In this video, I'm going to share with you a dividend stock that I recently added to my watchlist and is down a lot recently, more than 50%. But before continuing with this video, I want to clarify that I am not a financial advisor and this is not investment advice, of course. The stock that I'm talking about is none other than Intuit Inc, ticker symbol INTU. Year to date, it is down just over 57%, while during the last year it is down more than 62%, which is insane. And even when we look into the share price performance during a much longer time frame, it still looks terrible. During the last 5 years, the share price is down more than 40%. But besides all these facts, there are many other things that made me believe that this stock, at the current valuation, could potentially be a massive opportunity. The app I use to invest and I have the vast majority of my investments is Degiro. I leave my link below for those who are interested. If you sign up from my link, you will get back some of the fees you pay for your first transactions. Also, I know that's not something that most investors do, but personally, I use multiple investing apps. I mostly did this to get the bonuses, because at the end of the day, it's free money they give to attract new customers. I will leave these links too, in case you are interested. Before continuing, I think that it would be better to start with some general information about the company, so everybody knows what we are talking about exactly. Intuit Inc. provides financial management, payments and capital, compliance, marketing products, and service in the United States. The company operates in four segments: Global Business Solutions, Consumer, Credit Karma and Products. The Global Business Solutions segment provides QuickBooks services, which includes financial and business management, online services, desktop software, payroll solutions, time tracking, merchant payment processing and bill pay solution, checking accounts and financing services for small and mid-market businesses and Mailchimp, and marketing automation and customer relationship management. This segment also offers QuickBooks Online services and desktop software solutions, comprising QuickBooks Online, QuickBooks Live, QuickBooks Online Advanced, QuickBooks Self-Employed, QuickBooks Solopreneur financial and business management offerings, QuickBooks Online Payroll, QuickBooks Checking, QuickBooks Desktop Software subscriptions, and QuickBooks Assisted Payroll. The consumer segment provides do-it-yourself and assisted TurboTax income tax preparation products and services. The Credit Karma segments offer consumers with a personal finance platform that provides recommendations for credit card, home, auto, personal loan and insurance products, online savings and checking accounts, access to its credit scores and reports, credit and identity monitoring, credit report dispute, credit building, tools and tools. The Pro Tax segment provides Lacert, Pro Series and Pro File desktop tax preparation software products, and Pro Connect tax online bill pay tax products, electronic tax filing service, and bank products and related services. It sells products and services through direct sales channels, multi-channel shop and buy experiences, mobile application stores, partner, and other channels. Intuit Inc. was founded in 1983 and is headquartered in Mountain View, California. Its industry is software application, while the sector it belongs is technology, of course. They have 18,200 employees, and the name of their current CEO is Azan Gudarzi. Intuit is a massive company, by the way. Their current market cap is 77 billion. And keep in mind that the share price performance is terrible, so it used to be much bigger, and not a long time before. The PE ratio they are currently trading at is 16.92, which in my opinion makes their valuation pretty attractive. This PE ratio is lower than the vast majority of their competitors, except for only Adobe, if I'm not mistaken. The same is true for their forward PE ratio, which is even better than their PE ratio, and still of course lower than their competitors. It is 10.33. Now let's get into their financials, and more specifically into their income statement. First of all, the revenue growth looks amazing. It's double digits revenue growth, ranging somewhere between 13% to even 32% in 2022. Last year it was just below 15%, so even now the revenue growth is impressive to say the least, and it doesn't seem like something we have to worry about. As for their basic and diluted shares outstanding, there is some dilution, but it's normal for these companies. We also have to keep in mind that the share price back then was nowhere near to today's prices. Most recently, they started buying back shares, which is very smart in my opinion. They are very strategic about the buybacks. They don't just buy for no reason. They're opportunistic. At the current levels, I would like to see them buy back shares even more heavily, and honestly, this is something I will keep an eye on. But the things I love the most about the stock is its earnings per share and its free cash flow growth. Starting with their basic and diluted earnings per share, they are growing at an outstanding rate every single year, recent year at least, with the sole exception of 2022, where their EPS slightly declined. In the grand scheme of things, this is nothing to worry about. Their EPS growth didn't only recover from that, it started even accelerating, and this continues even now. The most recent year, their diluted EPS were $16.51, while the growth was 34%. This is definitely not something you see often. Their free cash flow growth is truly magnificent. It grows extremely fast. In 2023, it slightly declined, but other than that, their free cash flow is heading in the right direction. And since almost everything about the stock is great, the dividend growth has to follow, of course. In the last 6 years, they have managed to grow their dividend by double digits. Last year, the dividend growth was 11.54%, but now let's continue with their balance sheet. They currently have $4.681 billion in cash and equivalents and $2.099 billion in short-term investments. So, in total, their cash and short-term investments is $6.78 billion. This is a huge amount that give a lot of freedom and options to the management, and of course peace of mind, since they don't have to borrow money for every single thing they have or want to do. As for its total debt, it's currently $6.817 billion, so it's almost equal to their cash and short-term investments. In my opinion, this debt is nothing to worry about, it's very manageable. Their net cash debt is only minus $37 million, which is a lot better than where it used to be. As for Intuit's dividend stats, it has a dividend yield of 1.7%, which is definitely on the lower end, but it's growing extremely fast, and this is also consistent. They have managed to successfully grow their dividend for 15 consecutive years, so even if your starting dividend yield is objectively low, your yield on cost will become much higher and pretty fast. It is interesting that while they are consistently growing their dividend, they have managed to maintain a very low payout ratio, just below 30%. This means that they have plenty of room to keep raising their dividends in the future. They are doing buybacks, but we have already covered this subject in depth. For every single share you own, you will get paid $4.80 every year, so $1.20 every single quarter. Analyst consensus for Intuit Inc stock is buy. For the next 12 months, analysts give it a low estimate of $276, which is pretty close to the current share price. So, according to them, the worst case scenario is that the share price stays around the same levels. They give it an average estimate of $491.30 and a median estimate of $460, which is massive growth, and last but not least, a high estimate of $921. This scenario is beyond crazy, and if it proves to be true, this would make today a generational wealth buying opportunity. To sum this up, they are expecting the share price to change from minus 2% to 226% growth. This is a very wide range, but for the most part, they are expecting exponential growth. As for me, I don't own any shares of this company currently. Honestly, I really like the stock at the current valuation, but I am still building my Zoetis position as of now, and I still have 3 months until this position reaches to a size I'm happy with. So, since all of my funds are going to this, I won't be having any money left to invest anywhere else. If I see the share price below $200 in the same period, I forget about Zoetis and I will buy into it, of course. This is very unlikely to happen, but if it does, remind me in the comments in case I missed it. I won't sell any of my Zoetis shares, I'll just put all my new funds into Intuit if this happens. It sucks, but I have to stick to my plan. When you only have a small amount of money to invest, you can't take advantage of every single opportunity out there, so you have to be selective. And once you make a plan, you have to stick to it. There is no other choice. It's not easy, but I'm doing my best. It's easy to get lost when you see people achieve insane returns in the short term, while I'm down 30% in a long period of time. But if I'm right, this is the best time to buy, and I might even be lucky to be in this position right now. But only time will tell. Let me know in the comments below what is your opinion about Intuit Inc stock, and what are your current plans. Do you maybe already own it? And also, let me know how is your invest journey going so far. Subscribe and turn the notifications on for more videos like this one, and thanks for watching. See you in the next one.